Welcome to the Lockshield Partners Podcast. We believe in financial literacy and love to provide quality information when it comes to areas around financial planning and how it impacts your life. To learn more about what we do and how we serve our clients, visit us at lockshieldpartners.com.
Dan, welcome back. We've got another edition of our Lockshield Partners Podcast today, and we're going to talk about one of our favorite topics today.
Love it.
Index funds.
Index funds.
Passive investing versus active investing.
Right. Love it. When I started in the business, it was all about active investing. Active just means buying and selling. And
I think Kroger will be better than Walmart, or I think
Pepsi over Coke, or stocks, bonds, U.S. International, a room full of Harvard MBAs, nothing against Harvard, a room full of Harvard MBA people selecting stocks versus passively investing in the market.
Sure.
And so Jack Bogle is a name. He's founded Vanguard. And he came up with this idea, much to Wall Street's displeasure. And he basically said, you can just buy the whole market, and
long term you'll be fine.
Long term you'll be fine. And what the data has shown is he's exactly right.
And really where that comes from, if you really dive long term, Dr. Eugene kind of the modern doctor of portfolio theory, I guess you could say, discovered that markets are very good at what they're designed to do. They're very efficient.
Yep.
They update the price of any tradable asset based on everybody's information and everybody's buy and sell orders and supply and demand and whatever. And so if that's true, and it's proven to be true, you might as well just buy them all.
There's not a lot of benefit in sending your team to Chicago or Los Angeles to watch shipments into McDonald's or Walmart or cargoes or whatever, because the market updates immediately.
That's exactly right. And if somebody's trading on information that's not available to everybody else,
well, that's a problem.
Insider trading.
People go to jail for that. You can ask Martha Stewart about that one. So we love index funds, and every week, every day, every week in our office, our phone rings nonstop with mutual fund companies, annuity companies, private equity, people who call on investment professionals who want us to pitch their fund. And it's really easy for Jody just to say, we use Vanguard. And that's the end of the conversation.
They don't call back.
They don't call back because they know they're not going to change their mind because the data works. So let's talk about the data.
Absolutely.
We're data people. 20-year return over the last 20 years. So here, let me frame this up a little bit differently. Let's talk about exactly what an index fund is and what an actively managed fund is. We've kind of touched on it, but I'll go with the index fund. So when I buy an index fund, I'm basically just hitching my dollars to the U.S. market or whatever index I'm in. I'm going to use the S&P 500 or the Vanguard total stock market.
Okay.
Wherever it goes, I am just trying to mirror. If it's up 20, if it's down 20, that's what I'm trying to do.
Great. In long term, we've learned that if we just park a dollar in the S&P 500, that should work out really well.
It has to this point.
9-10% a year.
That's exactly right. Yeah. So an actively managed fund, as you touched on earlier,
it's going to try to beat that.
It's going to try to beat it.
And I think it's important to note that sometimes it will.
Sometimes it does. And in any given 1 year, about half of the actively managed funds beat the S&P 500.
However, if we look out longer term,
when you start stretching the data out,
that gets less and less and less and less.
To the point where if we look over the last 20 years, 92% of actively managed funds have underperformed the index.
Let's say that again.
92% of actively managed funds have underperformed the index.
So that means as an investor, if I'm going to pick an actively traded fund, I better pick the correct one out of 10, and I better stick with it for that full 20 years.
That's exactly right.
Because if I'm switching between active funds, then your probability of outperforming is
going down.
almost zero.
Right, because investors have this uncanny ability to pick the wrong thing.
Time and time again.
Yeah, so they're going to pick what's hot,
Right.
and what's hot right now
Probably terrible next year.
is probably going to be terrible next year because they're hot because they made the right one or two or three choices.
Yeah. And I think there's a couple reasons for that long-term underperformance, Dan. Part of it is, again, we're boring and we like the data.
Yep.
We know that we can't guess the market. We can't time it. Which also means on a further level, we don't know what sector or industry or geographical area or whatever is going to perform better at a given time.
Right.
So if we don't know that, then it gets really, really hard to beat the market. And actively traded funds are also more expensive
Because they have to hire people to do these things.
all this trading.
Correct.
You're incurring trading costs and all that other stuff.
Tax efficiency and
Right.
all that kind of stuff.
So when you add all that together, it gets really, really hard to outperform the index.
Right. And some people get enjoyment out of that, which is great. But I'm a fan of listen to smart people. Warren Buffett's got a pretty good track record when it comes to money. If you're Warren Buffett and you've been doing this for 60, 70 years and you have a team and you have all of these things in place, you'll probably beat the S&P 500. There's a few Warren Buffetts out there. But I love what Warren Buffett says about, for most investors, buy the Vanguard S&P 500 fund. So if Warren Buffett, who I think most investment professionals or people who are in the know would say is really good at what he does, if he says, hey, this is what you should do, I'm probably just going to do that.
Yeah.
That's a pretty good shot. Back in 2008, when the market was tanking, the Great Recession, he made a bet, kind of a famous bet.
The $1 million bet.
The $1 million bet. So he bet, I don't know if it was 30 some odd hedge funds, or he put a bet out there and like 30 some odd hedge funds took him up on it. And he said, I'm going to put $1 million in the S&P 500. Whoever can beat it, if you can beat it, you'll take my money. And not a single one beat him. And the S&P, the data, this is from Motley Fool, by the way, if you want to dig it up. But the data, the S&P 500, just buying the index, over the next 10 years was up 126%. It was 5 hedge funds, sorry. Their average return was 36% over that 10 years. So the index outperformed the professionals 4 times. Where all that comes down to average investors is it's really hard to beat the index. And when you factor in the cost, the Vanguard index funds are 0.04 versus 0.7 for an average actively managed fund.
That's 15 times cheaper.
Right. So they may be better at what they do, but they've got to overcome a 0.7 or 0.65, 0.66% difference just to get even.
And that doesn't seem like a huge difference when you talk about a percentage.
Right.
But when you amplify that over 10 or 15 or 20 years, as we've looked at in our future value calculators before,
it's a big difference.
Major difference.
It's a huge difference. Yeah. So here's another reason why we love index funds is it avoids style drift. And so I've got my 457, my 401k, my IRA, and I might have 4 actively managed funds, which means on any given day, I've got 4 managers making decisions. And so my portfolio on January 1st may look very different on February 1st or December 31st.
Really without me knowing.
Without me knowing. And they may all be buying the same thing. They may be buying different things. They may be moving to bonds. They may be moving to international. So where we love index funds is from an allocation point of view, we can be surgical. If I want 60% in U.S. stock funds, I can put 60% in index or passive investments. And I don't have to worry about that 60 all of a sudden is 40 or 80 or whatever it might be.
Right.
And when bear markets come, it's really great to be able to say, hey, we want to ramp up our stock exposure. We're going to shift 10% from bonds into stocks, kind of thing. So
absolutely.
Closing thoughts on index funds as we land this plane.
I think it can have an emotional benefit too.
That's a big one.
You know what you have. There's a strong track record there. That doesn't guarantee anything moving forward. We know that. But
sure.
That's a lot of really solid data to rely on.
Yeah, and it's you can pick a couple good stocks and they do really well, but they could also do really bad.
Right.
And to your point of where we talked about GE being in the original Dow 30, the 30 best companies at that time, not a single one is still in the index. Which is another thing I love about the S&P 500 fund, which is that every year 2 or 3 or 4 companies move out and 2 or 3 or 4 move in, so it naturally rebalances as the economy rebalances. That's exactly right.
Right.
That's exactly right. Don't get me going on index funds. We can talk a long time about it.
Well, Dan, thanks so much. And if you have questions about index funds or active funds or passive management, please make sure to check out our website at lockshieldpartners.com.